Hi, welcome. Thanks for tuning in today. Today we're going to discuss about a difference between a stocks and mutual funds and how it the both are directly correlated. Now, before that, I wanted to understand this video is, say, for example, if you're trying to understand or thinking about investing either in a stocks or mutual funds, and how this actually works together, and what are the some of the things that you need to review before you take a look at any fund. So I'm just taking some specific example as we speak today. Basically, again, this is not any suggestions and all, and then I'm just giving you an understanding and how actually it works. Then again, you do your research and whatever the things, and then whatever the things I'm going to cover will be able to give you to take your own calls based on where your interest lies. And I'm going to connect when I said last time why future is optimistic, and then how this directly related to the services the companies are providing. That is number one. And then second thing is how that is the mutual funds, whichever the fund you take it, how they are directly getting into those business opportunities, whereas someone is managing the fund. So let's dive into it and try to understand. This is again, I'm saying that if you think of investing in a stocks or mutual funds, and these are the basic guidelines that probably can help you to understand. And then again, as I mentioned last time, start with slow and then build your confidence and try to understand and try to learn how it works rather than going blindly. So these are some of the basic understandings you must have before you getting into any of the funds or stocks, etc. So let's taking a little part of where to invest. So let's talk about stocks and mutual funds. Now, as I had mentioned, stocks are driven by, now BSE Sensex is driven by the top 30 stocks in terms of market capitalization. Now, what does it mean of market capitalization? I'll get back to you in a second. So same thing, NSE is driven by top 50, Nifty 50, people call it a 30 Sensex. So basically, this is directly correlated to the economy. This is the basic, again, the standards set or directives set by those rules and regulations. So basically, let's talk about Reliance Industries as we speak. Their market capitalization is about 9 lakh 5,000 crores, okay, as we speak today. And also SBI market capitalization is about 2 lakh 84 crores. So, and somewhere in between. So basically, this is driven by the top 30. So I just picked up 10 stocks, and there are another 20 stocks, which is basically, or the topmost capital, which has a capitalization of their net assets. Again, capitalization divided by the number of the stocks, and that derives the stock price basically. Now, either you call it, Sensex 30 or Nifty 50, it approximately works the same thing. As I mentioned, Reliance, as we speak, holds about 9 lakh crores, somewhere in between. Now, what it has to do with the mutual funds, I'll come back to you in a second. So, how does these 30 numbers derive? So, basically, it is derived based on the number of, again, market capitalization. So, they set a standards, for example, for the top 30 stocks. That's how the economy is also driven. Why? Say, for example, if the Reliance is capitalization, say, they're 4% out of the entire BSE or NSE, they're driving the market, say, for example. Now, if anything happens to this stock, pretty much it affects the entire whole. Like, you see the BSE from 40,000, if a 4% of anything happens to that stock, it might go down. So for example, if anything happens to these top 30 stocks, definitely you can count on it from 40,000 range, it goes down. Because these are the maximum. I'm not saying that other stocks are not important, but then basically these 30 stocks or 50 stocks are closely monitored, closely being seen. Also, this actually the amount of volume in terms of trades, and the business itself in terms of capitalization of how much of amount is there. So that's how it is derived. So if you want to get more deep into it, pretty much you can do your research, you can look at it. So that is based on my understanding, I'm saying, and then this pretty much it is, a BSE 30 and NSE. So you can blindly pick any of these stocks pretty much, these are called blue chips. They're, in terms of capitalization, they're in high, and pretty much, instead of buying a penny stock, you can look at it where your interest relies, and then pick your best picks and stay long enough. I'm not saying that probably, again, I'm just coming back to the companies can go bankrupt in 20 years out of this one. Maybe you can just, because we cannot predict the future, but then these are the past trends that we have. So you can look at any company or any of these names, you look at the 20 years data behind, and then see where the stock was 20 years ago, 10 years ago, and then you see where they stand. Based on that, you can take your own calls. I mean, wherever your appetite, or so that is getting into the stocks. I mean, if you're confident in, say for example, boss, this is, absolutely not our cup of coffee. So let's say, the easy way to do it, let's say mutual funds. Now I just picked up, you can Google it and you can see top 10 best performing stocks. I mean, I'm sure you find Axis Blue Chip Fund, either you do it regular or growth. So again, regular fund has more of fees. I think direct funds has about less 0.8% of, I think I was just referring 0.8% is charges basically you pay for a year. Now leave that aside. Now why I'm referring this one, so that you can understand any mutual fund is invested, three categories, either equity. So this fund is purely 93% is driven by the equities. So anything happens to the stock market, now anything of the valuations and any of these particular stocks go down, it is directly going to affect this net asset value. As I had mentioned, these things I didn't know before. So, so that's how it is all correlated. Mutual funds are directly, again, before you get into any of this, first thing you need to try to understand is a fact sheet of that particular fund. So that gives you a pretty much a broader idea of who is the fund manager, which are the industries they are, investing in. So that could be, blue chip companies or small caps or mid caps, and what are the specific areas where they're investing in. Like for example, on these top 10, you see Reliance Industries. Okay, it's pretty much mixed up. You can say TCS is IT driven, HDFC Bank is financial, Hindustan Unilever is basically the consumer products, HDFC Limited, again, it's mixed up with financials, and the ICICI is again bank, ITC is purely again consumer driven, Kotak Bank is a bank, Infosys is your IT, SBI is banking. So you see which sectors they are in, which is in the top. So pretty much I can see now is about 40% of this Nifty or BSE or NSE, the stock funds you see pretty much into the banking services. Okay, leave that apart. So like for example, Axis Blue Chip Fund, when I looked at it, so the major, it's about 93% was driven in equity. So equity, I just picked up out of 30, these are the top 10. You see how many blue chip fund like Axis Blue Chip Fund Direct Growth Plan invested in. See, in Reliance Industries, they invested 6.62 of 8,000 crores. Okay, in TCS, about 3%, 3.76 of 8,000 crores. HDFC Bank, about 9.17% from 8,000 crores. HDFC Limited is about 4.3% from 8,000 crores. ICICI Bank, they invested about 8% from 8,000 crores. Kotak Bank, close to 9%, again from 8,000 crores. Infosys, about 8.7% from 8,000 crores. So this is basically 8,000 crores of the fund, which derives again number of people who has holding their necessitous value. So today it values about 34 rupees. And the good news is its performance from the inception, as I said, you can Google it and you can see it, about 12%. 12% is better than 4 or 5% of your, regular savings, fixed deposits, etc., etc. So even though you pay 0.8%, or even say 1% as an, the fees what you're paying, you're still beating the inflation. At least, these are the best fund. I mean, this is the top 10 funds out of this. So you Google it, you'll find it. It stays on the top. So I'm not saying that this is the best fund. I'm just picked up, randomly. Those are just for you to understand how these mutual funds are directly driven when they say blue chip, when they say equity, and this is where they get into it. Say, for example, again, it's a different categories this they invest. If it is not equity, if it is a small cap, again, they going to pick up the small cap funds which has a future, which again, it's pretty much into a, speculations, how the fund is going to do in the future, etc. So I want you to understand, anything happens to the market, say when I say market, anything happens to these specific stocks. Say, for example, when the people say that market is crashing or market is going down, so what does it mean? That something is happening fundamentally to these stocks. Whatever the false news is, it could be the good news is false news is, or maybe the economic what's happening around the world. For any kind of news is, pretty much we have seen a lot of movement up and down in the market. So, but however, suppose even though if you have these mutual funds, so in case if there are 90% of 93% of this one is invested in this, say for example these stocks, I would say in top 10 stocks they picked up 1, 2, 3, 4, 5, pretty much about 7 stocks they have just by in top 10. So they have another many more others. So what I'm saying is that when the market goes down, say for example in 1 year down the line, 2 years then down the line, from 40,000 it went down, so pretty much all these top 30 will affect. Now when all this is affecting, indirectly or directly, your mutual fund NAV is going to go down. It doesn't mean that the fund is doing bad. It is basically indirectly these funds had already had effect. These particular individual stocks has effects. So for example, if the Reliance goes down in a big way, it's going to affect that 6% is going to affect that entire NAV. It's not that all 30 funds are going to go down, or maybe there are some specific stocks will go down for whatever the reasons could be. Now, but then what understanding you should have is that you should never get panic and sell it like what I did a couple of years ago. When the NAV goes down, it's fair enough. But then, again, which are the stocks which you are into it? And it's not that, they're going to stay for 1 or 2 years in those down times. I'm sure, businesses are going to find a way to cope up and then, come up with their strategies, and then they eventually bounce back. But just because the numbers are going down in terms of the BSE or NSE doesn't mean that the entire economy and everything is collapsing down. And that's where people need to control their emotions. Then most of the time, what I have seen, what everyone has seen is that when the stocks market goes up, everyone started buying, and that's pretty much is the wrong concept. And then when the selling more happens, or for whatever the false news XYZ, everybody starts selling it. So what is happening is that it is driven by the emotions. You need to have, the what Mr. Warren Buffett always said, that when the market is greedy, means like it's going up, you stay away from the investments. When market is going to its lower, you get greedy. So that means when it is going on, you buy on dips. And again, when buy on dips means like you need to have a confidence in the businesses you are investing. So if like for example, that particular stock has its, the fundamentals right, everything is going well, it's okay, it's a momentarily news going up and down. But then if you have a long-term view and you keep saying invested, and that's how many people make fortunes, because they have a different strategy than doing a trading in a daily, day in and day out. Probably for a 1 rupee 50 paise profits people sell, but then again every time you sell or you buy, you pay a brokerage. So every transaction you do has its price too. So what you wanted to take out of this video also, that just because some things are going down, so if this NAV say tomorrow or in a years down the line it gets to 20 rupees, so indirectly some of these stocks are not doing good. So but if you still have a confidence on this particular fund and that particular manager or particular whoever is looking at the overall performance, and they will find a ways to flexible enough to change their strategies and then get up do their work, so that you get your money back. So, looking at average, as I said, it's a 12%, which is fair enough. You're beating always, better than the regular investment strategies you might be having. But having a more understanding in these kind of things is most important for you to succeed. Overall, I want you to understand only one thing. So if you have a good risk appetite and then you have try to understand whatever. So for example, if you're confident enough, okay, that Hindustan Unilever is where the subject you wanted to get into it. This is driven by the consumers because HUL any product. When I said last time, you look at the product which you are using at house. You see how many Hindustan Unilever brands are your product which you're using. I'm just giving example. Or say for example ITC, maybe like food, any of that, I mean, the cookies or etc. Or mostly ITC is driven by the tobacco. But then you look at it, the habits of the consumers. Like for example, you can say smoking is injurious to health. Every day you can hammer the people, but then that's not going to go down because people are still going to smoke. That's most of the areas, whatever it is. I just don't want to get into it. But then you see, this is how the businesses are driven, and then top businesses are already staying on top of it. And then people is who is the consumers, who is into these businesses, who's buying in the businesses and getting into it. And then if you really want to get into the mutual funds, which is in a safe zone, some the fund managers who manages the funds, and you can see the track record of the fund manager, how is he doing and what was his past performance, etc., etc. And they are professionally doing. It's okay to pay like 1%, 2%. In a long run, it is going to cost you that 1%. If you stay in it for 10-15 years, the 1% margin bill, it's extremely a big amount. But then hey, you know what, if you're not a professional doctor, if I'm not a professional doctor, I would rather lose 1% than giving to a professional who can do a better job than me burning my hands in putting somewhere which I'm not aware, just by speculating. So that is something that I want you to take out of this video. If you're really thinking to get into it, either stocks or mutual funds, and these are the opportunities that you might have, and you do your own research. And then the same thing, you can when I picked up one, you pick up another 10 funds and see where they are investing, and that you can come to know only from the fact sheets, whichever the mutual funds you want to get into it. And then educate yourself, and then the more you get educated, the more you're curious, and then whatever the 10% or 15% of your the savings which you can pull out from your daily or monthly, that can get you into right places where you would be able to see yourself financially secure, and then which can give you returns for yourself and your families. And mostly it's, once again I'm repeating, it's not what you make today, it's what you keep today will give you the results for the future. With that note, I would like to leave it today, and I wish you have a wonderful evening. And if you like this video content, please do comment and share, and what are the experiences you might be going through, and do share with the people who you think that this kind of information can help them to increase their understanding and awareness in terms of investing. Stay blessed, stay tuned, and thanks for watching this series, and see you in the next episode and next video. Bye bye.